Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the week ahead. I'll be talking to our Head of Research, Jasper Lawler, to discuss the ECB and the BOJ meetings, US tech earnings including Amazon, Facebook and Google, UK bank earnings including Barclays, Lloyds and RBS, and the British pound reaching its highest since Brexit. Before that, I'll run down some of the top corporate results to watch this week. UBS and Google parent Alphabet report first quarter results on Monday. We also have earnings from Volvo, Harley-Davidson, United Technologies, Coca-Cola, Caterpillar and 3M on Tuesday. Costa Coffee owner Whitbread report full-year earnings, and there are quarterly earnings updates from Santander UK, Lloyds, GlaxoSmithKline, Twitter, Visa, Facebook, PayPal, eBay and Ford Motors on Wednesday. Capita announces full-year numbers, and there are first quarter updates from Deutsche Bank, Volkswagen, Norwegian Air, Barclays, Total, Royal Dutch Shell, Fiat Chrysler, PepsiCo, General Motors, Intel, Amazon, Microsoft and Starbucks all reporting on Thursday. Then we round off the week with the first quarter earnings from Airbus, Daimler, Royal Bank of Scotland, Chevron and Exxon on Friday. Phew! Moving on to the economic calendar, we have Eurozone and US services and manufacturing PMIs out on Monday. On Tuesday, there is Australian CPI and German IFO. On Wednesday, it's the weekly EIA crude oil inventories. On Thursday, it's the ECB interest rate decision and press conferences, as well as US durable goods orders. Then on Friday, it's Japanese inflation, the Bank of Japan policy decision, UK first quarter GDP, as well as first quarter GDP from the United States. So Jasper, two very important central bank meetings coming up.
Well, that's right, Kelly. They are important, but probably they're not actually going to do anything this time around. But we're still looking for signals as to what they're going to do in the future, and that can still cause some big market moves. For the ECB, firstly, the euro's literally not moved in 3 months against the dollar. We're at pretty much the same closing price when we record this video as we were 3 months ago. So that is a consideration for the ECB. Obviously, they don't target the exchange rate, but it's not been heading higher, so it's not a dampening an effect on inflation like it was a bit of a worry a few months ago. So that's a positive for them removing the stimulus. The downside really is that actually partly why the euro hasn't gone anywhere is that inflation's really moderated. So in March, it was 1.3% in the Eurozone year over year. That's up from 1.1% in February, so it's obviously an uptick on a monthly basis, but still last year in March it was 1.5%. So again, not really gone anywhere, not up near its 2% target. So there's not really that pressure on the central bank to do anything. So my suspicion here is that Mario Draghi, in his press conference, is probably fairly cautious, fairly dovish, probably fairly confident on the outlook for the Eurozone economy, in terms of the economy, but he's going to talk about this inflation not really going anywhere, and he's probably going to reference, risks to the outlook, like the trade wars, like perhaps, moderating economic growth, a sort of general trend in protectionism, and just the volatility in markets. So all those put together, I think, is probably caution. For the Bank of Japan, it's been interesting because Governor Kuroda, he has actually been talking about the fact that they are discussing how to exit the stimulus program. So behind closed doors, the Bank of Japan are trying to work out how to do it, but they haven't given any kind of timeline yet. So he's not ready to give an open forum, an open discussion as to when they exit. So for the time being, we expect more of the same from him. We did get a quarterly review of, this time around, we are going to get a quarterly review of their economic projections. 2 weeks ago, we had a regional survey, which was quite upbeat. So I would reckon that's probably going to translate into this national outlook. Probably pretty upbeat on inflation, where it's going, and the economic outlook, but just not ready to talk about exiting the stimulus program yet.
Okay. And as I read out earlier, so many big companies reporting earnings. Do you think the tech companies are still going to grab all the attention?
Yes, well done for getting through them all. I think so. Well, the trouble is when you have so many earnings coming out, is where does the market take its focus? Where does it take its lead? And historically over the last few years, it has been the tech firms. We've actually got some reports coming out in the lead up to the tech earnings season, one of which talks about this seasonal effect of how actually in the month of May, tech has outperformed in the last 5 years every year over the broader market, mostly outperformed 80% or so of the time over the last 10 years. So it has led the market higher after earnings season, after these Q1 results come out. So we're expecting the same thing again. Obviously, this time around, some of these tech firms have had some problems. So again, we're going to get into some of the nitty-gritty on Facebook and Amazon. Facebook got the data scandal. Amazon, we obviously got Trump kind of coming down on them a little bit. We're going to talk about that in a couple of reports as well. But the question overall is, will these earnings be good enough for investors just to put those concerns aside and buy back into what is essentially a bit of a dip in some of these share prices at the moment? If we look at what happened with Netflix, which was the only really big tech firm we've seen release results so far, the answer would be that they are going to buy into it. Netflix shares were up 9% the following day after their earnings, so that was a big jump. They are somewhat isolated from the kind of risks surrounding data privacy and things, but nonetheless, that to me bodes well for some of these other results coming out. Okay,
yeah. Grant, and moving on from tech stocks, back here in the UK, it's more banks that are releasing earnings.
Yeah, I would say so. And the outlook's brightening for the banks, I think. I mean, we're pretty much putting the PPI scandal behind them. They're not really having to make the provisions they once were. Some of those pre-financial crisis fines that they were really struggling with, they seem to be in the past as well. So now, when you're thinking about buying some of these bank stocks, normally one of the big considerations of why they're so heavily owned is the dividends that they pay out. And so we saw at the end of full-year results that Barclays are going to reinstate their dividend back to the levels before they cut it. So Barclays' dividends back up. Lloyds have already reinstated their dividends. So the next one to do so is RBS, and they're looking at full-year earnings growth. Obviously, RBS, I would say, is probably the biggest potential reward here. But obviously the biggest risk, because you still got that government ownership, and we're not quite sure when that's going to shift.
Yeah.
But if it moves in the direction of RBS being able to pay a dividend and being able to get rid of that government ownership, then obviously that points to higher stock prices ahead. With Barclays specifically, they have Barclays Capital, and so I expect some of the same things that we saw with the US banks, which is basically the volatility in the markets really played into the hands of their trading divisions. They have good revenues there.
Okay, and another British phenomenon, the pound reaching its highest since Brexit. That's quite an event.
It is massive. Who would have thought it when we were down at 120? To be fair, we've been with some of the more bullish out there. But the caveat obviously is that it's against the dollar. So, against the euro, it's not quite as impressive against a basket of trade-weighted currencies. The pound's heading in the right direction for sure, but it's not quite as obvious. It doesn't have this dollar weakness factor that's factoring into cable. The data over the last week was quite soft. And so if anything, that takes away from the chance of a May rate rise from the Bank of England. But, as you can see from the reaction in the markets, we still had that high up at over 143. The data saw the market pull back a bit, but I still think it's just a pullback within a bullish trend for the pound. And then actually, ultimately, inflation's still above 2.5%. It's above the Bank of England's target. They've been pinpointing a May rate hike all along. So they may as well go for it in May, and they can always just say it's a sort of one and done for now and give themselves rooms not to do anything if should Brexit fall apart later on. Or if things start to pick up in the economy, then they have room to start talking about another one. I mean, the squeeze on the cost of living is now officially over based on the latest data. Wage growth, even though it's disappointing, is still now faster than inflation. So with that gone, the economy should actually pick up again. And for me, I think probably they do hike again later in the year, but they're not going to signal it yet.
Right, okay. Thank you, Jasper. And thank you all for watching. If you wish to catch these videos as they're released, please follow LCG on social media.